Hello again, this is Dr. Phil Rosenkrantz. Welcome to EGR 403 Online, number 2. This is Overview of Accounting, Part 2. Please go to slide number 2. Looking at the big picture, we're still talking about accounting, but we're on 2 this time. And if you go to slide number 3, we had started talking about our financial statements, and in the last presentation, it had talked about the income statement. Now we're going to talk about the balance sheet, which is a snapshot or a picture of the health of the company in terms of what they own and how much they owe. And this is valuable because it discloses information to the management of the company and to investors. Let's go to slide number 4. Like I said, the balance sheet is a picture of the financial health of the corporation at some point in time. And usually it's done quarterly and yearly. It's based on the accounting equation, which is assets equal liabilities plus equity. In layman's terms, what we're talking about is the whole value of what the corporation owns is equal to how much they owe plus how much they actually own. And let's move to slide number 5 and get into some of the definitions that will help clarify that. Let's talk about assets. The assets are traditionally shown on the left side of the balance sheet, and these are what the company owns in terms of current assets such as cash, short-term investments, accounts receivable, inventory, and prepaid expenses. What are accounts receivable? Accounts receivable is money that's owed to you by customers where you've shipped them some goods or you've provided a service and you've sent them a bill, but they haven't paid the bill yet. So that's called accounts receivable. Now when they pay the bill, you convert that from accounts receivable into cash. And that's done through an accounting process, which I'm not going to explain at this point. Inventory is also going to be mentioned later on in this presentation because that's very important to a company, and anytime you're talking about goods and manufacturing, inventory comes into play. Other assets are property, your plant and equipment, long-term investments, intangible assets such as goodwill, in other words, what your name is worth or what the value is of the perception of your company in terms of the ability to use that name to sell goods and services. And then other assets such as patents and copyrights. Let's move to slide number 6, talk about liabilities. Now we're on the right side of the balance sheet, and liabilities are amounts owed to third parties. There are 2 basic types: current liabilities or your bills. Accounts payable are where you have received some goods or some services. You've received a bill, but you haven't paid it yet. So that's called accounts payable. There are accrued liabilities and where you owe somebody some service, and notes payable. And that would be, say, a swing loan or a just a short-term loan for cash flow purposes. The next category is long-term liabilities, and these are bigger loans and bonds. A lot of times you have to borrow money to buy buildings, plants, equipment, stuff like that. And so you'll have a mortgage, and so you'll be making loan payments, and you'll owe on those loans. Other things like bonds are, which I'll mention on another slide, are long-term liabilities as well. The equity side of the balance sheet, again, it's on the right side, and this is the ownership of the company. And sometimes this is called owner's equity or shareholder's equity. So you'll see these 3 different words. And it's a valuation of what's been invested and reinvested in terms of common stock or additional money paid in capital, money raised, and retained earnings. And the retained earnings, you recall, came from the profit and loss statement. Okay, please move to slide number 8. So now we're looking at what the format would be for a balance sheet. And you can see in a traditional balance sheet, the assets are on the left, liabilities and equity are on the right. And what you need to understand is that the totals for all the items on the left side must equal the totals for all the items on the right side. They must balance, and that's why this is called a balance sheet. So on the left, you're saying this is what the company owns, and on the right, you're showing how that ownership is divided up between debt and equity. Okay, let's move to slide number 9. How is the balance sheet used? Well, the balance sheet, as well as the profit and loss statement and the other financial statements, are published annually in a company's annual report. And the annual report is sent out to all the shareholders so that they can look over how the company is doing, and it helps them evaluate if they want to stay invested in the company. Do they want to buy more stock or sell some stock, or what do they want to do? It's also used by managers to manage the company. And potential investors look at the balance sheet and the other financial statements to decide if they want to invest in the company to begin with. Each industry has a different blend of assets, liabilities, and equity that typify what a successful company should look like. So a railroad company would have a different balance sheet than a theme park would, or than a food processing company. And investors and analysts understand this, and they can look at a balance sheet and analyze it and get an idea of what the health of a company is. They use ratios to analyze the balance sheet. There are dozens of different ratios and different ways of analyzing that data. A couple examples would be the acid test, where the current assets are divided by the current liabilities, and you want that to be a ratio of 1 or more. In other words, do you have the ability to pay your current debts off? The debt to equity ratio is a ratio of the liabilities to the equity part on the right side of the balance sheet, and that ratio can be compared to what people would be considered to be healthy, and it helps manage a company. So the balance sheet is very important to accountants. Let's move to slide number 10 and talk about inventories for a moment. Inventory refers to the raw materials that have been purchased, the work that's actually in process, that is the stuff that's in production, and the finished goods that are ready to be sold. Then these are all owned by the company. The inventory represents money that's tied up, and that money is tied up until the product is actually sold. So it's not really considered an expense yet. It's considered an asset. When the products are sold, then you can charge the expense off in determining your profit. High inventory costs can really hurt your profitability, because money tied up in inventory isn't money that's earning interest for you in a bank. It's not working for you any other way. And so companies really put a lot of emphasis today on minimal inventories. They still want to meet their customers' needs, but they want to do it with a minimal amount of inventory. Let's go to slide number 11 and talk about bonds. Bonds are one of our long-term liabilities. Some of you recall voting for bond issues when you go to the polls, and those are bonds that the state would actually be selling. And companies can sell bonds. These are sold to raise money. And they're used a lot with utilities and governments, but they're also used in industry. And that's what I mentioned before. They're used to raise money. Now, bonds are rated based on how stable the company or the city or the state is, whatever the entity is that's backing the bonds. And the higher the rating, then the less risk of losing your investment. Bonds have a face value of $1,000. At the end of the life of the bond, when it matures, then the company redeems that bond for the face value of $1,000. However, the bonds are bought and sold before that point at market value. And the combination of the market value and what the interest being paid on the bond is and when it's redeemable determines what the value of the bond is. Okay, let's go to slide number 12 and give an example of what this might look like. Let's suppose the face value of a bond is $1,000 and the interest rate that's paid on that is 10%. And let's say it's a 5-year bond, so at the end of 5 years, the $1,000 will be redeemed. And the bond is sold April 1st of year 1, and the interest will be paid 2 times a year. On April 1st, 5%, or $50, will be paid to the bond owner, and again on October 1st. So you know how much money is actually coming in. It's not variable. It's fixed at that $50. And so the market value of the bond, that's what it's actually selling for on the bond market. Okay, let's go to slide number 13. Now the relationship between the stated interest rate for a bond, the 10% mentioned on the previous slide, and the market interest rate determines whether the bonds will sell for a discount or face value or a premium. If a bond is being sold at a discount, that means it's selling on the market for below $1,000. The stated interest rate then of 10% is going to be lower than what the actual market interest rate is. If a bond sells for its face value, or for $1,000, then the stated interest rate is the market interest rate. If bonds happen to be selling for greater than $1,000, then they're selling at a premium, so the stated interest rate is less than the market interest rate. So the bond market is where bonds are bought and sold. Most of them are buying and selling at a discount. Very few of them are selling at a premium. And so you can use that information, how much you paid for it on the market, how much the dividends are from it, and when it's going to be redeemable, and figure out what the value of it is. Okay, let's move to slide 14 and talk about common stock. The equity part of the profit and loss statement refers to common stock. Common stock are shares of ownership in the company that are sold to provide capital to finance the beginning or the expansion of a company, of a corporation. And like I mentioned, this is often called common stock. There are other kinds of stocks, but common stock specifically refers to ownership in the company. Owners of common stock usually receive dividends from profits, typically 4 times a year. Those are called quarterly dividends. And the initials IPO stand for the phrase initial public offering. And that's when a company first is selling stock to raise money for the company so they can take it to the next level. They will have an initial public offering of common stock, and that's when it's made available to the public. So sometimes you'll hear that an acronym IPO, and that's what it means. Stocks are sold often on different stock exchanges. The New York Stock Exchange and NASDAQ being 2 you hear about on the radio all the time. And that's where common stocks are sold or traded. However, stocks can also be sold and traded privately. They don't necessarily have to be traded on an exchange. Okay, let's move to slide 15. Talk a little bit more about common stock and common stockholders. The stockholders have the right to, first of all, share in the residual assets of the corporation if it's ever liquidated. And that's kind of tricky because sometimes if a company is liquidated, let's say it goes out of business or it's sold out or something, if you sell off all the assets and you pay off all the debts, and then you look at the money that's left and you share it among the common stockholders, that could be nothing, or it could be very little, because all the debts get paid first. The shareholders get to share proportionally in the common stock dividends. They maintain their ownership in the business. And so even if you own one share of a company, you have that much say in the management of the company, because the shareholders are the ones that are responsible for selecting the board of directors. The board of directors are responsible for deciding who's going to manage the company. If you only own one share of stock, you may not have much say in the company, but you're entitled to a copy of the annual report, and you're entitled to go to the annual shareholders meeting, and you're entitled to speak at the annual shareholders meeting. So right of ownership is a very sacred thing in our country. Common stockholders, as mentioned, get to vote on key issues facing the corporation. The more shares you have, the more votes you have. Okay, let's move to slide 16. Preferred stock is another kind of stock. Preferred stockholders don't have any ownership rights, but they receive dividends before the common stockholders do, and it's usually more consistent in what it is. And then if the company is liquidated, they get their value of their stock replaced before the common stockholders do. So it's another way of raising money, but it has slightly different ownership overtones. Okay, let's move to slide number 17. Talk for a minute about investing in stocks and bonds. I find that students in this course enjoy hearing about that because we will be talking about some of these issues again later on. Stock is usually traded in blocks of 100 shares, and profit is made two ways. One from dividends, and what we've mentioned what those are. That's the distribution of quarterly profits. But another way money is made from stock is through appreciation. If you buy the stock at a certain price and then it goes up in price, goes up in value, and you sell it at that higher price, then you've made money through appreciation. So those are the two ways that money is made. And typically when you purchase a stock for a company, you can look back at their pattern of dividend distributions and their pattern of appreciation and decide how it is that you're primarily going to make some money on that. Bonds are purchased at market value, and profit is made two ways. One is the dividend that's paid according to the schedule that's stated on the bond. And then the second way is either sold for market value or held until maturity for the $1,000 face value. So those are the basics of stocks and bonds. We'll talk a little bit more about these later. Let's move to slide number 18. Here's some investment considerations. Stocks and bonds markets vary in opposite directions many times, and so investors will put a little money in each one so that they can diversify their portfolio. The word portfolio is really just means your collection of all of your assets, the things that you own, including your investments. And anyway, as you diversify your portfolio, invest in different things, what you're doing is you're hedging against different economic situations, such as inflation or recession or changing markets. If a company grows in size, so does the value of the common stock and the size of the dividends. So there's a long run aspect to investing in stocks from the standpoint that if the company grows and becomes more and more successful, then your share of that is going to grow and become more and more valuable. The length of ownership of stocks and bonds affects tax treatment because items that are kept less than a certain period of time are taxed at ordinary income tax rates. Items that are kept beyond a certain period of time are considered capital gains and typically taxed at lower tax rates. Sometimes that period of time that we're talking about is 1 year, sometimes it's 18 months. It can vary depending on what Congress wants to make it to be. However, you need to keep in mind as an investor the timing of selling stocks and bonds because it affects how the government's going to be taxing you on any profits you made. In general, bonds are less risky than stocks, but then again, you can't necessarily make some of the big profits as well. If a company is liquidated, bondholders are paid off ahead of common stockholders, so that might be something to consider. Well, that ends presentation number 2. Thank you very much.